If you have student loans and you have decided consolidation is the right move for you, this video is going to walk you through exactly how to actually do it, start to finish, step by step. No tricks, no traps, just the straightforward process. Quick disclaimer before we start. This video is for general educational purposes only and is not financial or legal advice. Loan terms, programs, and eligibility rules change over time. Always confirm current details directly with your loan servicer or at studentaid.gov before making any decision about your own loans. Step 1. Figure out exactly what you have. Before you consolidate anything, you need a complete, accurate list of every loan you currently hold. Log into your account at studentaid.gov. You will see every federal loan under your name there, including the balance, the interest rate, and the servicer for each one. Anything not listed there is private. Check your private loan statements separately, or contact those lenders directly to confirm your current balance and rate. Write everything down in one place before moving forward. You cannot make a good consolidation decision without knowing exactly what you are working with. Step 2. Sort your loans into two categories, federal and private. This matters because the consolidation process is completely different depending on which category a loan falls into. Mixing up the process for each type is one of the most common and costly mistakes borrowers make. Federal loans consolidate through the Department of Education. Private loans consolidate, really refinance, through a private lender. These are two separate systems with two separate applications, and they do not combine with each other. Step 3, for federal loans specifically. If you have multiple federal loans and you want to combine them into one, you will apply for a Direct Consolidation Loan. You do this directly at studentaid.gov, at no cost, through the official online application. There is no fee to apply for a Direct Consolidation Loan. Never pay a third party to do this for you. The application itself takes about 30 minutes to complete. During the application, you will select which of your federal loans to include. You are not required to consolidate all of them if you would rather leave some as they are. You will also choose a repayment plan for your new loan at this stage, so it helps to already know which plan fits your income and goals before you start. Let's walk through the repayment plan choices one at a time. The standard repayment plan spreads your balance over 10 years with a fixed monthly payment. It results in the least total interest paid over time, but the highest monthly payment. Graduated repayment starts lower and increases every 2 years, which helps if you expect your income to rise steadily, though you pay more interest overall compared to the standard plan. Income-driven repayment works differently. Your monthly payment is based on your income and family size, not your loan balance. This can lower your payment significantly if your income is modest compared to what you owe. Some income-driven plans also lead to forgiveness of any remaining balance after 20 or 25 years of qualifying payments. If public service loan forgiveness is part of your plan, you will need to select an income-driven option here, since that is a requirement for staying eligible. Two timing details are worth knowing before you submit anything. First, if you are still in your grace period after recently leaving school, consolidating now ends that grace period early and starts repayment immediately. If you would rather keep those remaining months, wait until the grace period ends naturally first. Second, if you have already been making qualifying payments toward public service loan forgiveness, consolidating resets that count, since a direct consolidation loan is treated as a brand new loan. Check how many qualifying payments you have already banked before deciding whether restarting the clock is worth it. Step 4, still on federal loans. After you submit the application, processing typically takes several weeks. Keep making payments on your existing loans during this window, since they are not paid off until the new loan is finalized. Missing a payment during this transition can still affect you. Once your new direct consolidation loan is issued, your old federal loans close out, and you are left with one loan and one new interest rate. That new rate is a weighted average of your old rates, rounded up slightly. Your new servicer will send you updated payment details, so confirm that account is set up correctly and that autopay carries over if you had it before. Let's make that weighted average idea concrete with a simple example. Picture two loan statements side by side on a desk. One shows $15,000 at 5% interest. The other shows $10,000 at 6% interest. Your new blended rate is not just splitting the difference between 5 and 6. The bigger loan pulls the average closer to its own rate. Run the math, and the new consolidated rate lands around 5.5% once the standard rounding rule is applied. Here's the honest takeaway on federal consolidation. It does not lower your rate the way a good private refinance sometimes can. The real benefit is simplification, one payment instead of several, and access to repayment plans you may not have had before. If lowering your interest rate is the actual goal, and you have no federal protections on the line, private refinancing is the tool for that job, not federal consolidation. Step 5, for private loans specifically. If you have private loans from one lender or several, combining them means refinancing, not a Department of Education program. A private lender pays off your existing balances and issues you a single new loan with new terms. Before you apply anywhere, pull up your current rate on each private loan, the same way you did in Step 1. Then request quotes from several lenders, not just the first one you see advertised. Rates vary based on your credit score and income, sometimes significantly from lender to lender. Compare every quote against your own current rate, not some generic number you saw in an ad. Step 6. Applying for private refinancing. Most lenders offer a rate check using a soft credit pull first, which does not affect your credit score. Use that step to shop multiple lenders side by side, at no cost and no risk. Once you pick a lender, the full application usually asks for proof of income, your existing loan account details, and identity verification documents. Before you sit down to apply, gather your documents ahead of time so the process moves quickly. Pull your most recent pay stub or a recent tax return as proof of income. Have your driver's license or passport ready for identity verification. Print or download your current loan statements for every private loan you're including, so you have the exact account numbers and payoff amounts on hand. Having all of this in one folder before you start turns a stressful application into a 15-minute task. While you're gathering paperwork, it's also worth checking your credit report itself, not just your credit score. Free reports are available once a year from each of the 3 major credit bureaus. A refinance offer is priced off what's actually on that report, so catching an error, like an old account that should have been closed, before you apply can mean the difference between a good rate and an average one. Step 7. Read the new terms carefully before signing anything, whether it's federal or private. Check the interest rate, whether it's fixed or variable, the new monthly payment, and the full repayment term. A longer term lowers your monthly payment but raises your total interest paid, so weigh that trade-off against your own budget rather than just the monthly number. Step 8. Once everything is finalized, confirm your first payment date and set up autopay if it's offered, since many lenders and the federal system both shave a small discount off your rate for enrolling. Update any budgeting app or spreadsheet you use so the new single payment shows up correctly. Step 9, and this one gets skipped often. A few weeks after consolidation closes, log back into your old loan accounts and confirm each one shows a zero balance and is properly closed out. Paperwork errors happen. Catching a missed loan in month 1 is far easier to fix than catching it months later. A few mistakes worth avoiding along the way. Never consolidate federal loans through a private lender if there's any chance you'll want federal protections later, since that conversion cannot be undone. Never assume a private refinance automatically saves money just because it's one payment instead of several, since that depends entirely on whether the new rate is genuinely lower. And never pay a company to file your federal direct consolidation loan application, since it's free directly through the Department of Education. Here's another one. Don't rush through the paperwork just to get it over with. Every real decision in this process, your repayment plan, whether your rate is fixed, how many forgiveness payments you might reset, is buried in that fine print. Skimming it is how people end up on a plan that doesn't fit their income. One more, specific to private refinancing. Don't stop paying your existing loans the moment you submit a refinance application, assuming approval is a formality. Applications can be delayed or denied based on your credit or income check, and a missed payment during that wait can hurt your credit at the exact moment you're trying to improve it. Last one. Don't apply to 5 or 6 lenders all on the same day out of impatience. Soft credit checks are safe and don't affect your score, but once you move to a full application with several lenders in a short window, some of those become hard inquiries, which can ding your credit slightly. Narrow your list down to 2 or 3 strong offers using soft checks first, then move to full applications only with those finalists. Let's recap the whole process. List every loan you have, with the exact balance and rate on each. Sort them into federal and private. For federal loans, apply directly and for free at studentaid.gov. For private loans, shop multiple lenders using soft credit checks first. Read every term before signing, especially fixed versus variable. Set up autopay and confirm your first payment date. Then follow up a few weeks later to confirm your old accounts are closed. Consolidation isn't complicated once you know which path applies to your loans. The mistakes people make almost always come from skipping a step, not from the process itself being hard. If this step-by-step breakdown was useful, you know what to do. And if you're still deciding whether consolidating is even the right move for you in the first place, that's exactly what we're covering in the next video.